Bloomberg Audio Studios. Podcasts, radio, news.
Now, we welcome our TV and radio audiences for a conversation with one of the most respected traders on Wall Street. Paul Tudor Jones made his name calling the Black Monday market crash in 1987, shorting stocks during the largest single-day percentage drop in U.S. history. Jones became a gold bull in the aftermath of the GFC and bought Bitcoin as the money printer went burr during COVID. He also founded the Robinhood Foundation in 1988 and has helped since then to raise nearly $3 billion to get New Yorkers permanently out of poverty. Paul Tudor Jones, a co-chairman and chief investment officer of Tudor Investment, joins us now on set. Paul, it's great to have you here.
It's great to be here.
Thanks so much for joining us. I want to talk first of all, before we get into the markets, economics, and AI, about your philanthropic efforts and specifically a partnership that Robinhood has with Bloomberg in a contest called Pick a Ticker. You have a $10,000 bet, essentially, one long, one short. How did this contest go, and who was the winner?
Well, we did it right. It actually starts right before our investor conference that we hold every fall. This year we had 40 participants. We raised about $400,000 that went, three-quarters of which went to Robinhood. It was fantastic. The winner was Bill Ackman of Pershing Square. He was long Fannie Mae. And see, number two was a guy named Mark Gallant, who actually used to work for me, and three was Stan Druckenmiller. No surprise, he's going to always be placing. They came in, I think if you took the top 3 or 4 and you had made their bets, you would have made 7 times your money in 6 months. So it's a great competition. I really hope this year we can expand it so it'll be a much bigger group. It's $10,000. It's a 6-month competition, one long, one short, and yeah, it's a lot of fun actually.
Shout out also to Anna Nikolajewski, who got up there on the board with those.
She was our only female entrant. I hope we get a lot more ladies that'll participate this time.
So they have another chance coming up this fall.
Absolutely.
And I thought since we have you here, you could help us. Give us a tip. What's the one long you would hit for the next contest?
I would say probably the yield curve. It just depends on where I think it'll be higher at that point in time. Mine would be very esoteric, so let me think. Well, I would definitely be betting on substantially lower front-end rates. We'll have a new Fed chair within 6 months of that point in time, and I think Trump's going to pick someone who's going to be uber dovish.
Well, let's talk a little bit more about the yield curve. Matt and I were actually emailing at like 4 in the morning about the yield curve because it's broken a lot of hearts, that steepener bet. And the way you lay it out, short end rates coming down, you have concerns about the deficit, potentially boosting the long end. It seems like a no-brainer, but it feels like it just hasn't worked. So what's different this time?
Well, it's working. It's just, it's vol adjusted. It's just a slow-moving train. But I think in the long run, it has to work. We are fiscally constrained, and we're going to have budget deficits of 6% plus as far as the eye can see. So one of the major offsets, if I was the president, would be to lower my interest rate costs by appointing a Fed chair who is as dovish as could possibly be. That's kind of the playbook when you're 100% debt to GDP and you're fiscally constrained. You can see it happening in Japan right now. Wade is reluctant to raise rates more than beyond 50 basis points, even though they have inflation. Pick a number somewhere between 2 and 3%. I think they fudge the numbers down all the time. You got wage growth at 3.5% there. So that's, historically the way that you get out of a debt trap is you run the lowest real rates possible. You lower your interest burdens, and I'm sure that's what we'll see beginning when the next Fed chair comes.
Well, we definitely want to talk about who the next Fed chair might be and who you would like to see. But let's talk first a little bit more about the deficit, because it feels like you take a look at the bond market over the past few weeks, the past few months, you can see those fears being expressed. But concerns about a higher deficit feels like one of those evergreen issues out there. So give us first your feel, how you're feeling about the deficit projections that we've been getting, and also how you might invest around that.
Well, The Big Beautiful Bill is really interesting. It's first of all, it's a genius in branding. The name of it's a genius in branding. But I think what you got to do is you kind of you have to go to first principles. What would the actual budget look like if we were trying to balance the budget? If we were actually trying to balance the budget, what is the counterfactual to the Big Beautiful Bill? So if you actually had to balance the budget, it probably would be the Big Beastly Bill. And at some point down the road, who knows when that's going to be? Maybe it's next year, maybe it's the next administration, maybe it's 10 years down the road. At some point, probably, the bond markets are going to call BS on governments around the world playing chicken with them, right? So to give you an idea, if we were to balance the budget today, let's assume, first thing I would do if I was president, I'd appoint the most dovish central banker I could to lower interest costs. So let's assume that I could make a pact with my chairman of the Fed that I'm going to go through an austerity package. I'm going to balance it, but I need you to really drop rates to, let's say, 2.5%. So if you drop rates to 2.5% and you get a 50 basis point reduction, or let's say even a 100 basis point reduction in 10-year rates, that saves you $175 billion. The starting gap is $900 billion, so that saves you $175. Now I'm down to $725 billion that I've got to find through tax hikes and spending cuts. So let's assume that we're going to do this fairly. We're going to do 50% tax hikes in the rich, because they've benefited the most in the last 30, 40 years, 50% spending cuts. What does that look like? On the spending cut side, I would just to make it simple, let's just call it a blanket 6% reduction in everything. Social Security, Medicaid, defense spending, you name it. I'm just going to cut everything 6% across the board. That's what it would take to get you $360 billion, half of that $725.
Tough to do with Congress, right? You got to work.
I'm just saying there'll be a point where the markets are going to demand it. I don't know when it'll be. Maybe it'll be in my lifetime. Who knows when it'll be?
By the way, how do you invest around that? Because you famously made a lot of money shorting the yen and Japanese assets into the lost decade, which was another situation where you saw a country just boost its fiscal debt and deficits.
All right, I will get to that, but let me just finish the tax hike side.
Yeah.
So to get $363 billion in tax hikes, you're going to have to raise the top income rate to 49. You're going to have a 1% wealth tax annually, and you're going to have to raise the capital gains rate to 40. So if all we're going to do is stabilize debt to GDP, that's the Big Beastly Bill that's somewhere down the road. And again, who knows when it's going to be. Remember, you have Italy, France, and Japan, who on the current projections will be in worse fiscal shape than we are, and they seem to be doing okay. And that's why we keep going with the kayfabe in wrestling, the suspended reality, where we like to watch the show, but we know it's not real. So we know that these 6% budget deficits are not sustainable in the long run, but it's okay because it's okay now. It's okay in the short run, and it feels good, and it's not hard. It's actually really easy. Remember, in the first Trump administration, he normalized 4% budget deficits. That's what we had pre-COVID. And now in this administration, he's normalizing 6% budget deficits. So, and I'm not judging, I'm just calling balls and strikes. That's where we are. So with that in mind, knowing that we have a whole pricing structure that's created on something that's not sustainable, it's really, really hard to invest for the long run, because the day that it'll probably be the bond market first, or maybe it's the dollar, who knows. The day that we're called to carpet on that, and the day that you actually went through that exercise that I just described, then you know that multiples on stocks will not be where they are right now.
Right.
But are you short the dollar? I mean, you mentioned you're into yields.
I would say that the easiest long-term trades are, you know the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that. A lot lower because of that.
How much lower? We're off 10% from our high right now, 8%.
Yeah, I would say I think that's a year from today, that's probably a realistic assumption.
I want to go to one point that you made in that blueprint that you laid out, and that comes to appointing the most dovish Fed chair possible. Jerome Powell's term ends in May 2026.
Right.
We've heard from the president recently that he's going to announce some contenders sometime soon. Bloomberg News has reported in the past 24 hours that Scott Bessent has emerged as a pick. Kevin Warsh is under consideration. I mean, if you had your pick, who do you think is best suited for the chair?
Those are two great names. Those are two fabulous names. Again, if I was president, I mean, if I just think about President Trump, he's a growth guy, right? He's a loyalty and growth guy. You're going to be my pick if you're loyal to me. You're going to be my pick if you're a growth guy. And I'd pick a growth guy, and probably Scott would be more in line with that than Kevin would. They will have had a really close working relationship at that point. I also think, again, the playbook's pretty clear historically and right now. We are fiscally constrained. We're in a debt trap. You're going to have to run negative real rates to get out of it. That's what we did in the 50s. We had, if you'll remember, we had a variety of prices fixed by the Treasury while we had 5 and 6% inflation for a period of time. We're going to have negative real rates, and that's why you have to think about what is facing our policymakers in this debt trap as you construct your portfolio. So what would an ideal portfolio be in something like that? Well, what has worked so far? What has worked so far has been some combination of stocks, which won't do great, which would do terribly if we ever actually had, if they called us out and the bond market actually gave us an accident that then spilled over. But it would be some combination of probably gold, vol adjusted, Bitcoin, gold, stocks. That's probably your best portfolio to fight inflation. Vol adjusted, because the vol of Bitcoin's obviously 5 times that of gold, so you're gonna do it in different weights.
You said at one point you would allocate 1 or 2% of your portfolio to Bitcoin. Is it still?
Yeah, I mean, I think you just, particularly now that the roadmap is clear, then I mean again, if I'm a policymaker, I'm going to run really low real rates. I'm going to have inflation running hot, and I'm going to tax the American consumer to get out of my debt trap. And that's exactly what Japan, who's the most fiscally constrained in the world, doing. And it works until the population throws you out because you let inflation get too hot. So maybe you're in a world with 3.5% inflation and 2.5% overnight rate, and you're kind of trying to run hot and grow your way out of it.
Well, let's talk a little bit more about equities. You know, you mentioned in that scenario that you laid out, equities obviously would do terrible, but where we stand right now, I mean, we're back to 6,000-ish on the S&P 500. We're slightly positive for the year. It feels like after the big performance that we saw in May, though, that people are not sure where to go from here. So assuming we continue along this path where inflation is under control, it seems like the labor market is under control, and trade negotiations continue to progress. I mean, what's your base case on equities right now?
Well, again, so a year ago, I never thought the bond market would tolerate the big, beautiful bill. I just didn't think it would. I thought, wow. I thought there'd be a revolt. I thought bond vigilantes actually had some stuff. But
they've come back out?
But they clearly haven't surfaced. And
we haven't seen inflation.
Well, there's a couple of things going on. One, we know 12 months from now, rates are going to drop precipitously with a new Fed chair. Was it last week when Donald Trump saw after, was it ADP? I'd drop rates 100 basis points.
Yes,
so we know where his head is. We know who he's going to appoint.
Well, and just now, the vice president, J.D. Vance, said this is monetary malpractice in a tweet reply to our Joe Weisenthal. So they really want the Fed to cut rates.
So that also is a tailwind for the bond market, right? Because short rates right now aren't going to be there a year from today. So that's a tailwind. And again, I think the biggest threat to the stock market has been our fiscal profligacy, something like the big beautiful bill, because that was always going to be a threat to the safety and security of the bond market, whether investors would tolerate what's going on. And right now it seems like both globally and domestically that the world's okay with kayfabe, kicking the can down the road. We're going to suspend reality. It's okay. Mm-hmm. So, and in that scenario, again, if I have to make a decision on stocks and I think that rates are going to be 3% in 12 months, yeah, I'm probably long.
By the way, you keep mentioning kayfabe, and we're all kind of watching this knowing it's fake, but don't really care right now. Is that because we're not invested? Because Brad Gerstner has this idea, and Ted Cruz was on Bloomberg talking about it yesterday. I think it's Invest America, where you give every child born $1,000 and then allow parents or relatives to invest $5,000 a year. Then by the time they're 18 and the stock market continues to appreciate, they have a serious nut. But they've got skin in the game.
Yeah, I think it's. See, I'm the budget.
Hawk, and you don't mind spending $4 billion.
And the cranky guy, but that's the best $4 billion that would ever spend in history, because the idea of making kids stakeholders from an early age in capitalism is so important. Oh my gosh. And then allowing employers or relatives or whatever to build that account so that at an early age they understand the idea of entrepreneurship, of free markets, of self-individual excitement about understanding how productivity actually works, how we build things through our own sheer initiative. I think it's just spectacular idea. It's the best $4 billion this government could ever spend.
Mm-hmm. So there's a good way to add to the deficit, and there's a bad way. That would be the best $4 billion. I'm very conscious of the clock. We only have about 8 minutes left with you. So let's talk a little bit about AI. Mm-hmm. You've expressed concerns about AI in the past. In May, I believe you said that, it could be pretty disastrous if you think about, if you really put your thinking cap on. But I'm curious from the investment perspective, when you wear your investor hat, how do you view it then? I mean, there's plenty of things to get concerned about, but we were having a great conversation with Cliff Asness of AQR last week. He's had a real change of heart when it comes to AI. He's embraced it. Are you embracing it?
Well, for sure I'm embracing it. We tested 2 models last week internally. We have a variety of quant teams at Tudor. We tested 2 models, commercially available models. Where AI has gone in the last 4 months, is so incredible. These models do democratize quant modeling for the markets. Like, I can just think, I've been an investment in quant modeling for the last 30 years, internally, externally, a variety of ways. And what these new models do is there's a huge barrier to entry if you think about quant modeling, which is I need to have dozens. If you look at the big ones, whether it's 2 Sigma or Jump or whomever, they have hundreds, thousands of employees.
That's their edge. That's Cliff's edge, right?
with these new models, wow.
They lose the edge.
It's incredible what these new models do. And the reason that I bring that up, of course you have to embrace it in our business. There's larger issues regarding AI. I think, if you don't mind, I can't tell you because I don't really trade individual stocks that much. I'm actually using the models from a quant standpoint, so I can't tell you which companies to buy. It's pretty clear that this is obviously the most disruptive technology in the history of mankind. If I can just give you here's the way I think of AI. You're too young for this, but there was a great Twilight Zone.
Okay.
Great Twilight Zone episode where aliens came down to Earth and they had this, and they hand this book. It says "To Serve Man," and everyone goes, "Hooray! They're gonna save humanity. It's a humanitarian God." And it turns out to be a cookbook.
I was ready to push back, but you called me out. I haven't seen that episode.
Yeah. So anyway, we just had our Robinhood AI Poverty Summit on Monday, which I was at. Oh my Lord, the things that AI are going to do for education. There is no excuse for a low-income kid not to have the greatest education if his parents or caregiver is taking care of them. My gosh, they're going to have an individual tutor to walk them through everything. So it's really spectacular. The downside of AI is that we've been served, right? When I say we've been served, you had in February Elon Musk. You can think what you think of him with regard to his moral compass, but he's the Thomas Edison of our time. Said AI has the 20% possibility of wiping out humanity. There's the safety side that should set off alarm bells throughout the world, particularly in this country, particularly with this administration. And then just last week you had Dario at Anthropic, Amadei, am I pronouncing that correctly?
Anthropic is good enough.
So anyway, he said that in 1 to 5 years, we could have 10 to 20% employment because of the displacement of white-collar jobs by AI. So now we have
10 to 20% unemployment.
In this country in 1 to 5 years. So now you have this massive stability issue. You've got a safety issue and a stability issue, and within the big beautiful bill is a moratorium on AI regulation.
So no guardrails.
Oh my gosh, that is when you've just been served, and no one, see the interesting is no one in the AI community pushes back on this, right? Because anyone that understands it and sees how it's progressing, these models are increasing 1 to 500% in their efficiency every 4 months. Understand, these are real possibilities. So
Paul, how do we get to guardrails? Because in the case of the debt bomb, right, as Gary Schilling would call it, you've got bond vigilantes to push back. In the case of the AI bomb, which we fear, there's no government that's going to regulate this because they'll lose out to another government.
Right. So I've come to this realization in the last 2 years that actually I think libertarianism is as much of a threat to our society as socialism. It's the other end of it, right? And you've really got this libertarian bent that's taken hold of this administration. So many of the biggest backers, but oh my gosh, our country's built on, we're built on a system of laws and regulations about private property rights, laws against assault, robbery, etc. So what we have to figure out in a thoughtful way, which is why you have to sit down and begin a discussion, how do we have AI for good? How do we prevent the AI for bad, both on a safety standpoint and a security standpoint? One thing that we really need to do is, again, what is the government's responsibility? What are companies' responsibility? We're going to have this productivity boom, right? Capitalism is so spectacular at maximizing productivity, but it's actually really bad really bad in the tails, I'll say. It's really bad about distributing income in a society, in a socially beneficial fashion. The best example can be, if we look at, say, since the mid-'80s, if you look and see how the productivity gains in the United States have been distributed, it's about 15% to the bottom 90 and 85% to the top 10. And so what happens when you do that? Well, you get the incredible divisiveness that we have right now. We have a crisis of trust in this country. No one knows who to trust. Hell, we had a faction of the Republican Party storm the Capitol in 2020 because they lost an election. So we're at a really socially fragile time because of wealth disparity, and now we have AI that, unless we think about how we distribute those productivity gains in a way. So is it, Dario mentioned, we're going to have a token on every time a model's used. Bill Gates said suggested, I think 6 or 7 years ago, maybe we tax robotics. There has to be we need to sit down and thoughtfully think through how we distribute the coming productivity gains so that people are happy and not unhappy.
Paul, it's been a real pleasure having you. I appreciate you coming in, and I hope we can get you back sometime soon. Paul Tudor Jones, there, co-chairman and chief investment officer of Tudor Investment, also the founder of the Robin Hood Foundation.